The world's most critical semiconductor equipment maker is so swamped with demand, they're literally kicking their own research prototypes out of testing cabins just to find factory floor space. Welcome to Earnings Unscripted. It's July 15th, 2026, and we're looking at ASML's second quarter. Ticker is ASML.
Yeah, it's an incredible problem to have, and the results completely reflect that panic from their customers. Total net sales came in at about 9.3 billion euros, which is up 21% year over year. They're essentially kicking off this massive capacity ramp.
Which naturally brings us here to talk about it. Though, quick reminder, this is just our personal opinion, definitely not financial advice, so please don't base your trades on our banter. But Mira, the stock reaction today was completely schizophrenic.
That's a pretty good word for it.
No, I mean, it spiked incredibly hard pre-market, then the regular session opened, and everyone apparently panicked. It sold off deep into the red before clawing all the way back to close slightly green. Earnings per share hit 7.58, but I'm trying to figure out what spooked them in the morning.
I don't think it's an actual red flag. Wall Street just struggles with the extreme lumpiness of ASML deliveries. The real story here is they blew past their own guidance on gross margin. It landed at exactly 54%, mostly because of the completely unglamorous side of the business.
Wait, you mean the installed base segment again? The software patches and calibrations?
Exactly. Net service and field upgrades absolutely crushed Wall Street estimates. It's structurally a much higher profit margin. Fab operators are basically desperate for volume today, so they're paying huge premiums just to squeeze extra output from the older machines they already own.
Okay, that makes sense, but I'm actually way more interested in the new tech right now because I need to know why Intel, of all companies, is suddenly stepping up to validate those wildly expensive high-NA machines.
Well, it's basically a coordinated flex. For months, the market narrative, largely fueled by TSMC analysts, was that high-NA EUV is just fundamentally too expensive. You're talking about tools that cost north of $300 million a pop. People really wondered if fab operators would just string together their older equipment to save cash instead.
Right, trying to hack together a solution with what they already own. But Intel just blew that assumption up?
Totally. ASML and Intel timed this to show Intel successfully using high-NA right now for their 18A node. They're actively mass-producing the new Core Ultra processors with it. It proves the math actually works in reality. The CEO, Christophe Fouquet, literally said on the call, to reach that point, you need to have the right maturity of the platform. This is practically the time where the cost of high-NA is going basically to provide an advantage.
Okay, wait, walk me through that. How does a machine that expensive suddenly provide a cost advantage? That sounds completely backward, unless it magically prints money.
I mean, it kind of does. So the old method's called multi-patterning. If a feature on a chip's too small for a standard lens to resolve, they use an older tool to run multiple passes over the exact same wafer to etch the pattern. It's incredibly slow, and every single extra pass ruins more chips.
Oh, so it's like tracing a delicate drawing 3 times without moving the paper. If you bump the desk even once, the whole thing's wrecked.
Exactly. Your defect rate absolutely skyrockets. High-NA lets them do it in a single pass. The upfront hit's massive, but your yield goes way up. It finally crosses that maturity threshold they were talking about. And it's not just logic chips making this move. The memory side's making the exact same shift.
Oh, right, because all those AI data centers need insane amounts of high bandwidth memory right now.
Exactly. And it creates this perfect storm for the top line. They actually project memory system sales to jump over 75% this year. Chip makers are migrating to these new advanced nodes and completely ripping out multi-patterning for single EUV passes, right as the absolute volume explodes. They capture massive upside from both directions.
Okay, so that perfectly explains the pricing power. But looking at the sheer volume of these orders, we mentioned that factory eviction earlier. If all these machines are suddenly indispensable, how do they actually build enough of them in time? They can't just materialize a new mega campus.
Yeah, that's where it gets a little frantic. They have explicit requests from customers to scale up standard low NA capacity by 30% by next year. But like you said, they can't wait for real estate. The CFO, Roger Dassin, explained they're manually stripping out their current internal testing spaces. Quote, "We're freeing up cabins, so making sure that cabins are fully dedicated to output. Right now, we also have prototypes and R&D tools in cabins. We're finding another home for those tools."
Finding another home. That's such polite corporate speak for boxing up someone's life work and shoving it into a storage closet.
Oh, completely. It's a straight-up eviction. But they really have no choice. The demand curve's pulling everything forward aggressively. What's crazy, though, is how this pressure connects to the older equipment, specifically the older 3600D model.
I saw that floating around in the notes. They're practically killing off that older version this year, aren't they?
More like it's dying a natural death. They basically ran out of a specific optical block from their main supplier, Zeiss. Dassin mentioned they might have one or two shipping next year, but essentially they're entirely done with the D model, which is actually a fantastic structural catalyst for them.
Wait, how? Because if they can't sell the older model anymore, wouldn't that completely hurt their total shipments?
No, because it forces every straggler buyer onto the newer, much pricier models. The product mix naturally lifts their average selling prices going into 2027, totally independent of their raw unit volume.
Okay, so they get a baked-in margin expansion just because their supplier ran out of cheap lenses. That's an incredibly lucky structural tailwind.
Well, it's lucky right up until you realize how tightly coupled they are to Zeiss for absolutely everything else.
That's a pretty terrifying bottleneck to think about. If one supplier's lack of lenses literally dictates the end of a product cycle, you've got to wonder what happens when they try to ramp up the next generation.
Right, especially since they're targeting that huge capacity increase for next year. But management honestly doesn't seem stressed about the supply chain right now. They've just updated the full-year net sales guidance to somewhere between 43 and 45 billion euros.
It's wild that they can just confidently project a raise like that when they're actively scrambling for factory space today. So looking past next year, what's the actual risk here? Are we just assuming AI demand stays red hot forever?
That's exactly the risk. Roger Dassin actually admitted they're planning another massive capacity jump for 2028, up to, I think it was 110 EUV low NA. But he explicitly added on the call, of course, we don't have orders for 110 EUV low NA at this stage.
Wait, so they're front-loading all this structural capital expense based on what? Just vibes and soft signals from customers?
Pretty much. It's the ultimate, if you build it, they will come strategy. Plus, you've got their China exposure slipping this quarter down to 14% of system sales. They assume it'll stabilize, but if geopolitical export friction actually bites hard, they might not need all those extra machines they're planning to build.
Okay, so it's basically coming down to trust. Foundries trust ASML to deliver the impossible machines, and ASML's trusting the foundries to actually buy them 3 years from now?
Exactly. It's a massive multi-billion-dollar staring contest with the future. And for now, no one's blinking.
Let's hope Zeiss doesn't blink either. All right, I think that's a perfect place to wrap up. Thanks for walking through the madness with me, Miro.
Always a pleasure. Catch you later.
If you want more of these breakdowns waiting for you every earnings season, go ahead and hit follow. And just so you know, while ASML is busy printing chips, we're strictly printing code, since this entire podcast is completely AI generated. That includes our synthetic voices and the script, taking you from the raw filings to your feed on the exact same day. We're always taking requests, so send your favorite tickers to earningsunscripted@datamenace.ca or track us down on X.
See you next time.